Hi guys, thanks for tuning in to another episode of Nuggets News, or our monthly housing and economy update with our friend Martin North. How are you, Martin?
Pretty good, pretty warm here today, and boy, there's a lot going on out there in the real world.
There is, especially in the crypto world, but also in the macro world. It's been a couple of weeks later than normal, and we do apologise for that. But I guess both of us have just been crazy, crazy busy. But there's been heaps of news come out, so hey, it's always a good time to do these.
Well, the point is, there's lots of new news, so wherever you are in the month, and in fact, I think it's quite opportune that we waited for the unemployment number to come out.
Yeah. I guess for me, just the broad overview that we sometimes do is that I think we'll look back at this time as when the RBA and Phil Lowe did their backflip, the same as what Jerome Powell in the US did 2 years ago. So all that talk about, highly unlikely to ever go to zero, highly unlikely to ever do QE. He's written pieces about how this creates wealth inequality in the housing market. It's going to push up asset prices and cause speculation, and that is risky. So all those things that he warned about and spoke about and said that's not going to happen, it's just backflip. Okay, we're doing them. That's it. And that's kind of the long and short of it, isn't it, Martin?
Well, it is really, and of course, he is following the Fed and the playbook from other central banks. He's just late to the party. And indeed, in his last speech and minutes, he actually said, yeah, asset prices are going to rise because of it. Massive, of course, liquidity injection through the quantitative easing program. And he was at pains to underscore that he could do more in terms of quantitative easing if required. Interestingly, 2 points. One was he said, it would be good for the exchange rate to go lower. And of course, it's gone higher. It's now 72, 73, right? So that hasn't worked. And the other thing, of course, is that the comment that he made about negative interest rates, it's unlikely that we will go into negative rates, is basically the last promise standing from all the others he made. So I'm pretty sure that next year you'll find that we get into negative rates as well, and simply follow the European playbook.
Yeah, he will have to follow if everywhere else goes negative. I'm not as sure on that as I was pretty certain that we're going to go to zero and do QE. The thing that I find interesting as well is the way that he spoke about the currency thing that you mentioned, but the markets don't give you what you want. The markets say, well, everyone's doing this. Philip Lowe, I've said in the past, he's too nice, and the markets can sense that. And he says we're probably not going to go negative where everyone else is talking about going negative. And so Australia becomes the cleanest dirty shirt in the laundry. And he's saying we're doing this to weaken our currency, and the currency goes up because they're not doing those things, and they're not going to be as wild as other central banks. So Australia's going to face that problem of rising
Well,
currency.
and the fact of the matter is, our economy is relatively better placed than many other economies around the world. And we've got the virus more under control at the moment than many other parts of the world too. So there are reasons why international investors will still look at Australia as a relatively attractive place to want to invest. And in a way, that sort of supports the exchange rate rather than actually driving the exchange rate lower. What it does mean, of course, is you don't necessarily import inflation, you actually import deflation potentially if that is where you go. I guess the other important, sort of early conversation point is China.
Yeah.
And the trade relationship with China, which is going from bad to worse. And the comments in the last 24 hours signals to me that China is definitely flexing its muscles with regard to Australia.
Yeah, we did get some good news that we signed part of that pact with the 14 nations, and China was one of those, I think. But then China came out with the quote that says, if you want to treat China like the enemy, China will be the enemy, or words to that effect, was it?
Yeah, pretty much. And, they're still holding off on some of the imports, although they're still taking iron ore. And of course, the iron ore steel axis is so powerful and needed by China. So I'm not sure it's too much of an issue in the short term, but I do think the China Australian relationship is very critical to think about in the context of what's happening in the US, of course.
Absolutely cool. Well, let's get into these fantastic slides, Martin, that you always create for us. Okay, so first cab off the rank, unemployment's ticked up to 7%, and Scott Morrison did a little bit of a victory lap today. But as always, if we look underneath the surface, the full-time numbers, the hours worked, those little things aren't heading in the best direction.
No, and remember the Reserve Bank is still saying 8.5% by the end of the year. Now, I think they probably will revise that down a little bit, but the unemployment rate will remain higher. The mix of employment is quite important, right? We know that there are more people looking now. We know that there were a few more people in work, which is good. But the distortions that we see with particularly some younger people and their ability to get work, and the pivot towards part-time casual work, is also continuing. So this is not necessarily a totally good news story. Of course, there was a little of an uptick in Victoria, as you'd expect. But overall, if the unemployment rate is going to be a 7 and an 8 and a 9, at the end of this year, and the Reserve Bank is saying it's 6.5 or 7.5% in 2 years' time, that's a lot higher than it was, and that's going to be a significant drag on the economy. And we still don't know what's going to happen, whether the virus is really going to get caught down again, or whether we're going to actually get more international infections that come into Australia. There are so many uncertainties, and of course, every time the economy gets hit by the virus, the economy goes off the boil. Interestingly, there was some data today that said about 22% of businesses are still expecting their revenues to be lower than the previous month. This month, right? So not all businesses are actually feeling the love in terms of the so-called bounce back. So there is a recovery in areas. There is an unemployment adjustment going the wrong way. And if you look at this number, of course, this is still with JobKeeper in the numbers. If you take JobKeeper out and you count underemployment as well, we've still got 1/5 of the population basically not where they want to be.
Yeah, that did get extended. So the annual credit growth is one of my favourites to look at, and that gives us an idea. It's going to reflect through when these people lose their jobs, that they're borrowing less money at a time where you've got broad money, which is, I love that. It shows how sharply it's grown in Australia as well as everywhere else. So there's a lot more money out there. The system has been flooded with this QE, this money printing, and it sits there as reserves for the banks to choose who they want to lend to, their mates, or they want to take risks on small businesses. So it's all well and good to have more money, but it doesn't get into the real economy and people aren't borrowing.
Well, that's exactly right. And, broad money growing at 12%, that's pretty much a record. And that includes the superannuation withdrawals, JobKeeper, JobSeeker, all the quantitative easing. And so it's what's sloshing around. But the question is, where's it going, right? And there's a very important point to make. A lot of people are paying down debt, right? So we're seeing a lot of people reducing their mortgage exposure, despite the fact that there's a bit more mortgage activity with new loans. Other people are saving, so the savings ratio is very high. But in some cases, the people are saving because they know that they've got issues ahead. And with a credit growth continuing to slide, and this is the total aggregate credit growth, so it includes business, which is actually not doing very well, as well as consumer and mortgages. What it shows you is that there isn't a huge amount of demand at the moment for credit. And so whilst you can give a lot of liquidity to the banks, if they can't actually or choose not to lend, or if consumers or businesses don't want to or are unable to borrow, then it's not going to have any significant effect. And that's one of the big debates about inflation or deflation, right? So, you could argue that if broad money is where it is, that should put heavy inflationary pressure on the economy. Actually, not necessarily so if it doesn't hit the real economy. And with the credit so low, the credit growth so low, that might actually signal more deflationary impacts. And of course, the inflation, we've been below inflation target for years, and there's nothing yet in any of this data to suggest that inflation is going to go anyway other than stay very low.
Yeah, the other thing this chart highlights is that these two are pretty closely correlated or track each other. It's the chicken and the egg problem, but the relationship is important, that there wasn't a shortage. If credit and the amount of money is growing at 2 or 3, 5%, and that's the demand, it's being met. And so just deciding to chuck an extra 10% new money in there, that it's the tail wagging the dog. It's not how it's going to work. People don't just go out and borrow because the banks have got more money in their reserves, which is just a number on a screen. So yeah, they think about it like that, and they think it's going to stimulate. But I think time and time again, it's shown that it hasn't worked in other countries.
And that's one of the reasons why negative rates are used in Europe. So effectively, any money that are sitting in the bank's central bank account is now charged at the penalty rate, right? That's what negative interest rates are, firstly. So at the moment, it's pretty much zero here in Australia. So if it goes negative, that's a further signal that the Reserve Bank is trying to get the banks to lend more. And it's interesting that everybody, Frydenberg is saying, well, the problem has been that there has been insufficient lending capacity because of too tighter credit regulations and all those things. The fact of the matter is, the truth is that in fact, it's demand for credit that's very weak, and just allowing the banks to lend even more, even at very low rates, won't necessarily turn that around.
No, and a couple of other things I'd add there, that we've also got these studies and data now that shows that as you go more deeply negative, it doesn't have that effect, particularly on the majority. They have to knuckle down and save even more because they're not getting any return on that interest that they used to get. So that doesn't stimulate the economy and get people spending in the way that their textbooks tell them. But now we've seen in Japan that the negative interest rates weaken the banks so much because they don't have that yield curve and a differential to which is their profit. And now the central bank is saying, well, we're going to have negative interest rates, but then we'll pay the small banks, that negative part, so they're not being hurt by it. So it doesn't really penalise them for not lending either. It gets you back to square one. I mean, it's just nonsensical.
Well, that's right. And of course, all the research in Europe says, well, that banks, as rates come down, that they can't take deposit rates down below zero, but they get close to zero and then stop. And of course, that's pretty much where we are. Most deposit rates in Australia are now stupid. But what banks are then forced to do is take higher risks and take more speculative strategies, trading and derivatives rather than actually lending. So in fact, low rates steers banks into, unfortunately, more risky activity.
Yes. Okie dokie. So you've got the Roy Morgan data here that confidence is still down, but it has risen a fair bit from where we were in the depths of March.
Absolutely, yeah. So it fell off a cliff, obviously, when the virus hit, and it's coming back. But it's still below the long-term average, long-term trend. And there are other surveys, the Westpac Melbourne Institute survey on sentiment that was very, very strong. But that was, I think, more to do with the virus, and that was before the Adelaide affair, although it looks as though that might be under control now. My point there is that one of the key leading indicators for whether people are likely to borrow, be it businesses or consumers, is confidence, right? And if people are very confident about the future, then they are more likely to. So the fact that things are moving up into slightly more positive territory in terms of confidence could mean that there will be more demand for credit and businesses will borrow more. But it's still pretty shaky. And if you look at a lot of the business confidence indices, they're still relatively low. So there doesn't look to me to be a massive uptick coming in terms of the demand side.
And if we do, I think everyone is very positive at the moment about the future, but we saw how quickly that scare happened in Adelaide, and I don't think, again, we are not having the right conversations. It's kind of the focus is on, we got 2 vaccines and the early data looks really good. It's not really about, how can we have people out and about and still be safe and still get the economy going if we do have more outbreaks. And so the fact that people are really positive at the moment and then still not borrowing, what if we turn down again? And I think there's going to be a lot of hiccups along the way until we update the conversations that we're having.
Well, I agree with you there. And, the fact is we don't know how the virus is going to play out. If you look at Europe, if you look at the US, it's pretty horrible there. And, they're all banking on these vaccines, which, hopefully the news is good and let's hope it translates into a really good outcome. But it will take some time before they come through. And in the meantime, it means that borders have to stay shut, international ones particularly. And there's always a risk that you get a leakage out of the quarantine processes, which is going to cramp people's style. So I don't think that we can assume that everything is, wonderful and everything is going to get back to normal very soon. This is going to be a long, slow grind, in my view.
Yeah. Okay, so this is another chart on confidence. Martin, did you want to add anything here?
Yeah, so this is my own survey, and this again shows a similar pattern to the Roy Morgan one, so it has improved. But there's some really interesting gradation within that. So there are about 3 million households who are reliant on income from term deposits and savings accounts. The confidence there has just been trashed over the last 2 or 3 months as all the rates have come down. Many banks have taken rates into impossibly low territory, which means that people can no longer get enough from their deposit accounts to basically save or indeed cover all their costs. That's a big deal. And that's having a really negative impact. Many of them are now being forced to basically expose themselves to some sort of market risk, whether it's Bitcoin or whether it's stocks and shares or whether it's property or whatever it is. And in a way, the Reserve Bank is encouraging that, right? And they've said several times, people have to be able to, have to take more risk if they want reasonable returns. But that's a big deal for many people, and they find that quite difficult. The other end of the spectrum is property investors are still very negative. If I look at that, and that's driven by very low rents, the rental returns are still continuing to drop. Dropped down another 5 or 6% in the last quarter. In some areas, a lot more than that. We've also got some property investors in units seeing their capital value continuing to degrade, and the appetite for property investments are continuing to be very, very low. So whilst there are some signs of green shoots in some areas of the property market, not the property investment. Third area, just quickly, is that we're also seeing the cost of living still rising. And so incomes are flat, real income nowhere at all, but costs are also continuing to rise. And that's in the context of unemployment still being quite uncertain. So a lot of people are feeling quite uncertain about their jobs. So all of that's in the mix, right? When you try to actually understand what confidence is happening and how's it being driven. So you need to go granular to really see all the differences.
Yeah, and I just think it's one of those things that it's kind of become normal. But when did this happen? That the head of the central bank, who's traditionally been pretty reserved, just basically saying, yeah, you need to speculate and invest in more risky assets, and that's just the new norm. So well, maybe we'll look back on these things. I'm sure there's going to be some books written about these times. But 70% of Aussies have been impacted by COVID in some way. A lot of reduced hours, not necessarily losing jobs, but as you mentioned before, Martin, there's still a lot of people that are being supported by the programs that had to get extended.
Yeah, and my own theory is that we will see further extensions to these programs. I don't believe that they will turn into a pumpkin in March. I think this will run on for another few months, and probably until after the election. So expect more support. But of course, the longer you support, and things like, for example, businesses who can't fail, so you can continue to trade insolvent, that tends to have a sort of a bit of a contaminationary effect into other businesses, because you don't know whether you're trading with a business that actually is or isn't solvent in its own right. At some point, that will have to come back to normal. And so I'm still expecting some business failures in the course of next year or so. And of course, the extend and pretend with regard to mortgage repayments continues. We've still got many people, about 300,000 or so, perhaps slightly less than that now, but a reasonable number still on interest and principal holidays. Many of them have been reset. The number continues to fall, but there is a hardcore element, and you'll see later some of my data to explain why there is still a hardcore element of people who are really in significant difficulty. So we're not out of the woods yet, in my view.
Absolutely, and you've got some more data here about the departures and arrivals, and I remember reading the figures as well, just about immigration and tourism, and they are numbers well into the hundreds of thousands. That whether it's the students or just people holidaying, massive amount of people employed in that service sector part of our economy.
Well, that's right. And the other interesting point is the interstate migration. So there's a net migration away from Victoria up to Queensland, for example, and from New South Wales up to Queensland as well. And in fact, in my numbers, from my surveys and applying some of these lenses, I think there's probably 4,000, 5,000 net migration from Victoria up to Queensland, and about 2,500 to 3,000 from New South Wales to Queensland. So Queensland is one area to go. There's also net migration to Western Australia now, which is a bit of a reversal that we had some time ago. So there's a little bit of interesting stuff going on. But the other side is, of course, the international migration. The inward migration is very, very low. We've got people returning, of course, who are Australians, but almost no international migration. And the budget, suggests that net, the overall size of the population will go backwards in terms of those inward migrants.
I'm not sure about those Tassie numbers there, Martin. There might have been some vote counting fraud going on there. Tassie's the best place to move to.
Well, it's certainly got a lot going for it at the moment, with what's very clear from the virus, and there's still definitely some property investor interest down in Tassie, but there is also now a bit of a switch up to Queensland. The reason for that is the net returns, if you look at sort of net returns on investment property, it's about 3 times what it is in some other places in areas of Queensland. And the capital value of property is still relatively low. That's why some of the coastal areas down the coastal strip in Queensland are at the moment the hottest in the country.
Yeah, no, you can't compete with those sunny days in the middle of Tassie winters up in Queensland, Martin, that's for sure.
But then you have box jellyfish in the summer. So.
Okay, so CoreLogic data is telling us a 0.4% rise in October. Look, I know our mate Chris Joy was out and he's celebrating that it's all back on the rise. And to be honest, my point and my stance has always been that once QE happens, everything goes out the window. It doesn't matter about fundamentals anymore. We're going to see wealth inequality and all these things happen. but the stock market's going to go up, property's going to go up, and it's not really to be celebrated as I think Chris Joy and other property bulls are. It's well and good if you own all your properties and you're getting wealthier, but the social impacts, I think most people are going to see that around them, and that's I guess the equaling factor.
Yeah, and you've got to be really careful because aggregate measures like this don't really tell you what's really going on. There are certainly areas in the country where prices are definitely moving up. I was looking, for example, at Hunters Hill, which is an inner suburban area, quite posh area in Sydney, and prices there, they've moved up from 3 point something to $4 million per property. But that's a very unique part of the market, right? And it's a relatively small number of transactions, and they definitely are moving up. So I am seeing some movements in the inner suburban areas for houses in a number of centres, but I'm also seeing consistent falls in units in a lot of areas slightly further out, and I'm seeing a lot of falls in suburban houses out in the high growth corridors. So to really understand what's going on, it's really important to get granular and not just sort of hang on to that top level number. But there are some definitely, some green shoots in some areas. But I'd also make the point that if you talk to people like first-time buyers who are now confused as to whether they should pile in the market or not, and take some of those incentive schemes, some of them are saying, well, maybe I should because maybe prices are going to actually go up again. And sometimes I say that, yeah, but just remember that quite often it takes a bit of time for all of the negative consequences from, unemployment and the things to work through. And so, is this short-term or long-term? Is this a short-term reaction to the virus effectively coming back? Or is it something to do with quantitative easing, as you said? And all of those things are a bit artificial. And so trying to read what's really going on under the surface is really important. And just, I would remind everybody again, we've got high amounts of debt in Australia, even at these low levels, and that the banks are now a little bit tighter on some of their lending standards than they were. And there are also significantly more people listing their properties than previously. We'll see in the next slide. And so from a supply, demand, price equilibrium point of view, I'm not convinced that the conditions are actually going to support consistent growth in prices ahead. Maybe a bit of sideways, a bit of up, a bit of down. But there are still so many risks, and all to do with the broader economic risks and some of the other things we've been touching, that I would be a little bit cautious about saying it's all fine and we're going to see a 10% rise. Although, of course, some of the banks now are saying 10% rise in the next 2 or 3 years, not a problem. We'll see.
Yeah, so I've just got those numbers on screen, the yearly changes in terms of the listings. What I would just tack on to your comments would be, if something's overvalued at 900,000, it doesn't mean necessarily it's good buy if it goes up to 950 in 2 or 3 years' time. If that's when we then have another, whether it's Australia or global downturn or whatnot, the business cycle has to play out sooner or later. And Australia is not in as bad shape as other places. But, if America keeps running these $3 trillion deficits, he's going to come back to haunt everyone until we have some, honest conversations and reality checks and let things unwind. And Australia is going to be affected by that, just as we saw this year, regardless of what happens elsewhere. So, yeah.
And look, comparing the average price of a property in Australia and the US, it's about 4 times exposed here, right? In other words, we are putting 4 times our income in on average to cover the cost of property. And many new loans are being written at 7, 8 times income. Those are very, very high levels. And remember what I said about unemployment rising and incomes being under pressure and jobs being under pressure. That's the context. And we know that defaults are actually a little higher and will continue to rise.
Okie dokie. So interesting. Look, I'm not sure if this is something that we've spoken about specifically, but we did say that there's going to be all sorts of weird and wonderful measures put in place when this all starts to turn down. So I think we spoke about, QE, 0% rates. They're going to, I said in my documentary, they're going to reinvent these first home owner grants and builder grants. They're going to make them bigger than ever. All those things have happened. But then we've got these moratoriums. So, hey, house prices can't go down. And you saw the listings just then that have gone up. But it's harder for house prices to go down if people aren't selling them. So that's my thoughts there.
No, well, you're right, and the point there is that the CBA has said we're not going to do any foreclosures until later in the year. But of course, the process, if somebody actually defaults, the process of going through that whole process takes months anyway. So I'm not sure they're really giving much away. It's more a question of just accepting the reality. And, there is definitely evidence of more people getting into financial pressures. Some of the Hilda data came out today, I noticed, and particularly single parent families are well under pressure in terms of income. And so there are lots of things that people should be cautious of, but we are going to extend and pretend for a lot longer. We are going to see the banks continuing to talk the market up and talk everything fine. We're going to see the government saying the same. But some of these pressures that are really there under the waterline haven't gone away. And my own view is we need to be a bit cautious in just being too optimistic at the moment. We need to be realistic about the next 2 to 3 years.
Yeah, and if we have, let's just say there's 10,000 foreclosures a month and we're stalling these, well, it's all well and good if things aren't that great that we get to that date in September and all of a sudden we have 100,000 that need to be foreclosed, at once. What do we do then? Do we kick the can down the road again? It's so short term, all this thinking.
Yeah, and look, I have the theory that ultimately the RBA will probably end up buying bad mortgages off the banks, right?
Completely agree with that, yeah.
Everything is designed to keep financial stability very in the center of the target, right? And what that basically means is the RBA has given the banks very cheap funding to be able to allow them to lend. They've been given the ability to use bonds, and particularly even state bonds as part of their liquidity structure now. They've been given the chance to essentially not declare a bad loan if it gets reset in some way for a number of months. All of those things are in play. And then we've got the director's duties that says that you can continue to trade in an insolvent capacity, right? All of those things are in the mix at the moment. And so we are not really in a truly capitalist market anymore. We're in a very much controlled environment where people are trying to keep all the balls in the air to protect financial stability. And I'd argue that JobKeeper and JobSeeker and some of the other initiatives in the budget are actually really bank keeper, right? This is all about keeping the bank strong. So they will do whatever it takes to do that. But at the end of the day, there's a cost to it.
No, it's the path of crony capitalism. But okay, so mortgage stress hitting new record highs in October. We're still stepping our way up here, Martin. Is this lagging data or is this up to date?
No, this is right up to date. So this is up till the October period. So this is higher than it's ever been. So the thing about mortgage stress is it's trying to get at the cash flow. So how are people faring with money in, money out, right? And it actually did come back a little bit, but now it's at 40.6, which is as high as it's ever been. But again, you've got to go granular. Not all postcodes have the same issues, but there are some areas, units in particular, where there are significant pressures. And in those growth corridors, like Point Cook, Werribee down in Victoria, for example, where we've had massive amounts of construction over the last 5 or 6 years. Frankly, a lot of stuff sort of squeezed in on very small lots with very large mortgages. Some of those are now really under significant pressure. And in fact, when I look at where the stress and strains are actually appearing, that you can see real hotspots in each of the locations. And this is a concern. Not all of these will go bad. A lot of people will just muddle on for a few years. But nevertheless, because of this, I do believe that defaults will be higher later.
Yeah, so I've just got the state-by-state stress on the screen at the moment. And you've also got the kind of demographics here as well.
Yeah, well, let's just do the states first. So the first one is, I look at mortgage stress, I look at rental stress, I look at investor stress, and I've got a total financial stress measure for each state, right? And interestingly, it's ACT and New South Wales that has the highest level of overall financial stress, right? And that's maybe surprising, maybe not if you think about the sort of the property values and incomes there. Within that, you can see that in fact it is Tasmania still and Victoria that has the highest mortgage stress in percentage terms, whereas New South Wales has the highest rental stress, and the investor stress is pretty high in the ACT, New South Wales, but it's also pretty high in other places too. And so about 25% of property investors are under stress at the moment. So you can see the stresses and strains. And then on the next one, which is just another way of cutting the data, you can see how that actually positions by the demographic segments. And it's quite interesting that mortgage stress hits young growing families, including first-time buyers, 79% at the moment. The battling urban, the disadvantaged fringe, so those are people on the outskirts of towns in these high growth corridors. The rental stress is more broadly spread across different demographics and different groups, but a lot of young affluence. So, younger families or people who have, not yet got a family but are living perhaps closer into the city, have significant stress. Investors, of course, they're exclusive professionals, and the young affluent, they're the ones who are most geared up. They're the ones who have more multiple investment properties, so they've got issues. And you can see that financial stress is quite broadly spread. That's the point, really, that the more you look at this, the more you realize that there's a bunch of stresses and strains across the country, and you can't just sort of pick one group or one location. It's a much more of a patchwork.
Yeah, these are incredible numbers. 80% young growing families. The one that's interesting as well here is when you've got, I think a lot more people are going to want to be these rural families. And we saw the huge spike in lumber prices in the US, uptick in people building those homes. And it's a significant discount to build, let's say, a rural place anywhere in any state. But, some people, we hear the stories of moving down to Tassie and building, out of the way, and you can build a house for a fifth of the price of, what you can in Melbourne and Victoria. And so it's been in the country, the clean air and all those things as well, that's a lot less stressful. So if you can get a job or if you can work online, which a lot of people have learnt they can, that's where I think we're going to see a lot of change as well.
Yeah, I think, and we're seeing a lot of migration out from the urban centres into the regional centres. People preferring to look away from, the CBD and the surrounding area. So I think there's a bit of a sea change. It's facilitated by digital. People suddenly realise that they can actually do things more remotely than previously. And I do think this rural thing's quite interesting because there the dynamics are quite different. In fact, the grain harvest this year is, I think, a boomer. A really big one because of all the rain that we had. So, some of the rural areas are doing quite well relative.
After years of drought, and the fruit pickers and the tourists and all that over summer, there's going to be lots of jobs there as well. So there's a few interesting things happening there, which tip the scales in the favour of living rural. But next up, we've got those who have deferred, and a lot of people have started paying their mortgage again.
Yeah, so this is the interesting one. So if you look at the household distribution, which is the sort of the blue area chart, I then plotted the relative stress and the relative proportion who got deferrals. These are the principal interest mortgage deferrals. Interestingly, there's a higher proportion of more affluent people who got the deferrals compared with those who are stressed. In other words, I think my theory is, and it's coming through in some of my data, a lot of the people who are a bit smarter in terms of managing their finances took the opportunity when the bank said, well, if you want a principal interest holiday on your loan, feel free, right? And so they basically just, yeah, I'll take that. I'll put that money into some savings or whatever else, relative to those who needed it because they had significant financial stress. So what we've got is within that large number of households who had deferrals, there were a lot of people who were able to restart their repayments no problem at all, which is why the numbers have come down, right? But we've got a very significant proportion, about 25% in my view, of people who are really seriously stressed financially and who are on those deferrals and are struggling now to know what to do. That's one of the reasons why I think that we're going to see higher listings ahead. And it's interesting to watch the income footprint, right? So we see a lot of those more stressed households who are now still struggling on deferrals with the lower incomes and the more limited range of financial options than others. That's why I believe that we're going to see more listings, not necessarily before Christmas, but after March, when the current structures end, unless they extend them. And they probably will extend them, but that's what I'm thinking. That's what I'll see at the moment.
Yeah, and that does get reflected in the non-performing loans as well. I agree with you on your theory, though, Martin, that we saw a lot of people draw down their super. Now, some people have invested in maybe stocks or gold or silver, maybe Bitcoin and these assets which have rebounded really strongly. So sometimes these people might have speculated and done really well, or they've just used that as a period to pay down their debt, which we've also seen in the numbers. So really interesting that we do see those sort of differences there. And I'm not sure if that's illegal or just a grey area, but there'll be some fallout from that, I imagine.
Well, it's interesting because the banks were very willing to extend you had to really not prove much at all in the way of hardship or anything like that.
Mm.
With the superannuation withdrawals, which was the biggest chunk, more than 33 billion, you did actually have to have a reason for doing it, right? And now the ATO is starting to knock on people's doors and saying, "Excuse me, can you give me the rationale?" Right? So we'll see where that goes.
Yeah.
But the fact is that we are going to see, I think, a proportion of households who are in difficulty. In fact, on the next chart there, I just picked up the latest financial stability and reports from the Reserve Bank, and it showed that the non-performing housing loans continues to rise. I think we're going to see more of that ahead. And remember that a great chunk of loans at the moment are not actually being classified as in default, because APRA has allowed the banks to sort of reset the clock, as it were, if they restructure the loan. So if you go from principal interest to interest only, you can then start the clock again and the loan is fine. So I think that the impact on bad loans is probably much more significant than in the currently reported data, because of the various steps that APRA and the Reserve Bank have taken.
Yeah. So as Martin's saying here, guys, there's a huge amount of these which are kind of unaccounted for or being given a free pass, and that's already ticking up. And we know that Australians have got these record household debts, so credit cards and these things that have still got really high interest rates. But we've got a whole raft which other countries don't have of buy now, pay later, which has gone viral in Australia, pardon the pun, for the last few years. And that's kind of in the shadows, and it's not always counted in these other metrics as well. And it's a very fine line once you get behind, or you find out you've lost your job and these debts, and then you have to start to pay the fees, because there's normally, these are free services. So then you've got your credit card, which starts to top up at 10 or 15%. You're behind on that because you're behind on your afterpay. It's a very fine line, and that's why those figures can go pretty sharp all of a sudden.
Yeah, and it can veer quite quickly, right, as things begin to work. And buy now, pay later is interesting, just quickly. ASIC released a report this week on their latest review on buy now, pay later. And they made the point that about 1/5 of all people who use buy now, pay later are paying late fees. 1/5.
That's
right?
where they make their money. Yeah.
And well, they make money from that, and they also showed how much money they make from the merchants, because the merchants are actually paying for the facility, right? And remember what we said about some small businesses really struggling. Well, I can tell you one of the reasons why small business, particularly in retail, are struggling is because they now are having to use more of the buy now, pay later facility to try and get transactions through. It costs them more. So there's no such thing as a free lunch in this thing.
And I mean, that's we could do a whole episode on this, but I've been doing some research, and what we're finding is that the average small business, okay, your margins have been getting crushed by big guys, like whether it's Amazon or the Coles and Woolies, and now you're struggling to get customers, and you've got to pay the afterpay to get you a customer or to allow them to purchase an item. Or if you're that restaurant and you've got to pay Uber, that cut. So your margins are just getting squeezed and squeezed, and that's why so many businesses are going to fail. And it's at the hands of the big techs and the software companies a lot of the time who are from overseas, and so that money's not even staying in Australia. So this is very, very interesting, the way that the modern economy is sort of going. And at the moment, I don't think government are even thinking about any of this.
No, and it's particularly smaller businesses who really don't have the muscle that some of the bigger ones have. So it tends to lead in the long term to the concentration of larger businesses, with the deficit falling to small businesses. So the number of small businesses, are likely to reduce. About 1/3 of small businesses in my surveys are still saying that they don't expect to be around in a year's time, even now. So this is a big deal. It's not one that I think gets enough attention. And I'm very frustrated. In the last budget, there was a lot of stuff in terms of tax breaks on investment things. But frankly, if you're a business that's really struggling, you're not going to be able to invest in new kit just to get a tax break, or indeed even hire new people if you're not comfortable that your business is going to survive. And with the lockdowns, of course, a lot of retail and a lot of hotel accommodation and those sorts of things are all under pressure too. So I think there are some really important cracks again under the waterline here with regard to the SME sector. And I think those are going to play out over the next probably 2 or 3 years. But I'm not sure that being an SME is actually much fun at the moment, according to my surveys at least.
Alrighty, so you've got your summaries here, Martin. A couple of slight changes.
Yeah, just to highlight the fact that I've become a little more positive with regard to the future of property prices. So basically what I'm saying is, in the best case, if that vaccine does come through and it comes through relatively quickly, there is a path to high house prices from this point, absolutely. And I give that now a 30% weighting, so that's higher than it was previously, partly because the vaccines have started to appear. But I still think it's going to take time. I still think we're going to see this not happening, December this year. It's going to be sometime next year. And there's still a few question marks about some of the vaccines. However, we've also got this international crisis with regards to the virus in the US and in Europe and in the UK. UK has just long gone to another lockdown now. Many parts of Europe are locked down again. And if that plays out, then it could be much more serious. More likely, I think, here in Australia, we will have these sort of little events like we have around Adelaide, and they will continue, and that will continue to be like putting a foot on the brake every now and again. So my own view is that the longer term crunch, as I call it, is still my mid case scenario at 40%. So, but there is a path. There is a path to higher home prices than in my last modelling, and I'll run it again at the end of the month and see where it ends up then.
Yeah, and now you've got some free advertising, Martin, here in the last slide.
Well, I just wanted to highlight, I've changed my branding a bit, and we've now got a sort of a walktheworld.com.au homepage, which is a new thing, just to sort of put everything together. So people were always confused about digital finance analytics and Walk the World being my YouTube channel. So I thought I'd just highlight the fact that I've now got a rather pretty picture of the globe that's part of Walk the World.
That is part of our old logo, Martin, that we used to have as well. So there you go.
Didn't know that. No.
I used to joke it looks like Captain Planet.
Oh, very good. Oh, well.
Just wrapping up, what I would say is one thing that I think is going to completely sideswipe a lot of our elected officials is this civil unrest. So yeah. I think they've got no idea that the mistrust, and it's their own fault. All this stuff we've spoken about in the past about loss of trust in corporations, institutions, and leaders, and they're going to come out and tell people that they have to have this vaccine. And again, whether or not you even believe that those are good or bad, that's another conversation. It's just going to be some percent of people do not like being told what to do, or they're going to be concerned about the safety, or they don't believe that these things work, or they're dangerous, whatever reason. We are going to have civil unrest when they start telling people that you have to do this, that, and the other. And at a time when all our other financial freedoms and civil liberties and privacy are kind of been eroded, I think you're going to see civil unrest.
I think that's right. I mean, I wouldn't be surprised to see an enforced vaccination program for anybody, for example, wanting to travel overseas, for example, right? And the question is, where does personal freedom and personal responsibility lie vis-a-vis big government and the way that government just seems to be exerting its force? And, you look at it, control of digital, control of finances, control of civil liberties. It's getting more and more like a sort of country that, frankly, I'm not very fond of. So this is a big deal.
Well, guys, I hope you've enjoyed that one. I think it was great, Martin. So maybe we'll do it 2 weeks late every month. But we'll see you guys again next month. And take care, Martin.
Take care.
See you guys.